You have $1,000 to invest. You find MetroCoffee, a strong brand. The stock is down 20% to just $10, almost 10% dividend, $98 a year for doing nothing. It looks like a bargain. You buy it. You tell your wife and your friends. You feel smart. 1 year later, the dividend is cut and your $1,000 is now worth $600. You stare at the stock chart trying to understand what went wrong. But that is not where the answer is. An intelligent investor doesn't start with the chart. He starts with the financial statements. In the last 2 videos, we did exactly that for MetroCoffee. The balance sheet showed debt rising for 4 straight years to $120 million. The income statement showed $100 million in profit. So the logic seems airtight. If they are making $100 million a year, they can clear the debt in 1 year. The dividend is safe, right? That assumption has cost investors millions. Hi, I am Nick, the guy with a Greek accent and a long-time value investor. I know because I made that same assumption early in my investing journey. This channel exists because I wish someone had showed me what I'm about to show you before the market did. Profit is not cash. If a company runs out of cash, it goes out of business and you lose your capital. The third document, the cash flow statement, reveals what the cash situation actually looks like. By the end of this video, you'll know what a healthy statement looks like and what a dangerous one is hiding. The cash flow statement answers one question, but it has 2 parts. Did this business actually generate cash? And how did real money move in and out of it? To understand why that matters, you need to understand what the income statement cannot tell you. The income statement asks, is this business profitable? To answer it, accountants use accrual accounting, matching every sale to the cost that generated it, regardless of when the cash actually moves. If MetroCoffee delivers coffee to a hotel in December, that sale belongs in December, even if the cash arrives in February. Matching revenue to cost gives you a truer picture of whether the business model works. That matching is legitimate and important, but it requires judgments, and judgments introduce estimates, and estimates can be misleading. Think of the income statement as a doorman, intelligent, considered, but not infallible. The cash flow statement is a turnstile. It uses cash basis accounting. For the hotel deal, the income statement recorded it in December. The cash flow statement waits until February when the cash actually arrives. No matching, no judgments, no estimates. Just, did the cash move? Every movement of cash falls into one of 2 categories. Cash inflow, money arriving into the business. Positive numbers. Cash outflow, money leaving. Parentheses. The parentheses are the statement's way of saying this money left. But not all cash flows are equal. The cash MetroCoffee generates selling coffee is fundamentally different from the cash it borrows from a bank. Both are inflows, but one tells you the business is healthy. The other tells you the business needs help. That is why the cash flow statement divides every cash movement into one of 3 categories. Operating activities, the cash generated or spent running the core business every day, selling coffee, paying staff, keeping the lights on. Investing activities, the cash spent or received on long-term assets, a new espresso machine, a store renovation, a building sold. Financing activities, the cash that moves between the company and the people who fund it, a loan from a bank, a dividend to shareholders, a share buyback. Now let's open the statement. If you want to follow along and see all the numbers yourself, download the full MetroCoffee case study with all the financial statements linked in the description. Most public companies start with net income and adjust for non-cash items until they arrive at the real cash number. It is called the indirect method. The first section is operating activities. How much cash does this business generate simply by doing what it does every day? It starts with net income, $100 million, the profit figure from the income statement. And now the adjustments begin. Depreciation and amortization, plus $70 million. You saw this number on the income statement. It reduced profit, but no cash left the bank, so we add it back. Stock-based compensation, plus $10 billion. This number is buried inside general and administrative expenses on the income statement. MetroCoffee paid some executives in shares rather than cash, so profit fell, but no cash left the bank. The cash flow statement pulls it out and adds it back. Net cash from operations, $180 million. That sounds strong, but we are not done. Running 3,000 locations does not just mean cash coming in, it also means cash going out, a very different kind, one that does not appear here at all. It appears in the next section, investing activities. Capital expenditures, $150 million, in parentheses, cash out. The money MetroCoffee spent this year on its physical assets, new equipment, renovations, replacements, new locations. Not all of this is the same. Some is the cost of staying alive. Some is the choice to grow. The cash flow statement does not separate the two. It shows one number. And note, if MetroCoffee had sold any assets this year, the proceeds would appear here as a positive number, cash in. This section can go both ways. For MetroCoffee, this year it only went one way. Net cash from investing minus $150 million. The third section is financing activities. Dividends paid, $100 million, in parentheses, cash out. Every dollar MetroCoffee paid to its shareholders this year, including your $100 dividend on your $1,000 investment. New debt issued, plus $70 million, no parentheses, cash in. MetroCoffee borrowed $70 million this year, fresh debt, added to what it already owes. Net cash from financing, minus $30 million. And at the very bottom, net change in cash, zero. The opening cash balance was $40 million. The closing cash balance is $40 million. The account did not move. At first glance, that looks stable. But look at what just happened inside the statement to keep that number at zero. MetroCoffee generated $180 million from operations, spent $150 million maintaining its business, paid $100 million in dividends, and borrowed $70 million to make the numbers balance. MetroCoffee still has $40 million in cash, the same as last year. But ask yourself, what would have happened if MetroCoffee had not borrowed that $70 million? The company would have run out of cash. It would not have been able to pay its suppliers or its staff. The dividend would have been cut, not gradually, immediately. MetroCoffee's management had options. They chose to borrow money to pay shareholders. I know this pattern. In 2020, I bought shares in a Greek company. Great business, strong moat, bargain prices after the COVID crash. The income statement was healthy. The dividend was growing. The cash flow supported it. I bought it with conviction. But over 3 years, something shifted. Slowly. The debt kept rising. The dividend kept growing. And the cash flow that had once backed it began to tell a different story. The dividend was increasingly being funded by fresh borrowing, not by the business itself. I watched the stock climb to all-time highs, while the statements sent a quiet, persistent warning. I sold 80% of the position near the top, a three-bagger. Everyone around me was still buying. That is the loneliest part of reading the statements, being right before the crowd catches up. I didn't sell it because I predicted what would happen next. I sold it because the statements told me the foundation had shifted. A few months later, the price started to fall. It has lost 40% since then. I kept 20% of that position for the part of me that might have missed something. The statements give you an edge. They do not give you certainty. Now look at what a healthy cash flow statement looks like. Same industry, same products, different decisions. Daily Brew, operating cash flow $30 million, capital expenditures $25 million, most of it for growth. New locations, new markets, new equipment. The company is investing aggressively in its own future, using its own cash. Net change in cash, positive $5 million. No dividends paid, no new debt issued, not a single dollar borrowed. Same industry, same product. One company borrowing to keep shareholders happy, propping up a dividend it cannot afford and a stock price built on an illusion. The other is investing its own cash to grow. The cash flow statement showed you the difference in 30 seconds. One calculation remains: free cash flow, the number that tells you with brutal precision whether any business can afford its dividend, its debt, and its future. That is next week. And when you see what it reveals about MetroCoffee, everything across these 4 videos will finally click. If this changed the way you see a cash flow statement, subscribe. And if someone you care about is investing without knowing how to read the statements, send them this series. It might save them money.